But what are some of the, I guess, key takeouts from that latest RIA report that only came out in the last month or so? ESG integration, no surprise, makes up half of the market in terms of the RI assets. It is the most popular approach in terms of responsible investing here in the Australian marketplace, but probably globally as well. It's probably what we would regard as the lightest touch in terms of responsible investing, but it is fast becoming mainstream. And we would hasten to say that this is where all investment management is going. If you think about the signatories to UNPRI and their latest strategic intent over the next decade to make sure that investment managers are actually having real-world outcomes in terms of their portfolios and the way they invest, there is no doubt that every investment manager is going to have to consider ESG to some extent in terms of their portfolios and investments. But you can also see negative exclusions is actually increasing. No doubt things like tobacco, but increasingly things around fossil fuels. With the explosion that we've seen in ETFs, but also sustainable and, I guess, thematic ETFs, you've seen many more exclusions taking place as an approach to responsible investing. Corporate engagement comes up, particularly when you look at the super fund marketplace here in the Australian marketplace. Engagement, advocacy and shareholder activism are quite critical approaches that many of the managers are now taking. And then you'll see the other approaches in terms of sustainability and impact investing. To round that out, I thought it would be interesting ahead of the discussion today to give you a feel for what we think is on the landscape, not just from a responsible investing perspective, but I guess more aptly from an advice perspective. We think that climate and the transition that the Australian economy has to undergo, obviously we now have a federal government that is in the most part committed now to climate transition. So that is going to be an enormous change for whole industries, for whole sectors, for whole communities. And no doubt that will flow through to the share market and the sorts of investments that you can or will be able to make today and in the future. Not everyone will make the climate transition and there will be winners and losers. And that has portfolio implications for you. Increasing regulation. So we saw overseas that the EU taxonomy has led in this space for a very long time, but you've also now seen the SEC in the US, you've seen the ASX, ASIC and APRA all come out with guidance around labelling and greenwashing and wanting to see much greater alignment, and they will regulate more and more around this alignment between the label that you put on a product and the outcome that you deliver, particularly when it comes to ethical or ESG or green labels. And then the final thing will be that measurable impact. How do you take what you invest? How do you measure the portfolio outcomes against things like carbon footprints, net zero commitments, and also SDGs? And we know that the regulation will push more and more of that, but also the investor demand is actually there for more transparency as well.
As an introduction, I think it's also important to think about why that's the case and reflect on why we're seeing such growth in ESG or sustainability. I think is probably a broader banner and just what that means. I think we're at a zeitgeist or we're at a changing time. The zeitgeist at this moment is to focus on not just profit and improving the profitability of companies, but also growth of companies in a sustainable way. And the ability to identify good companies, what a good company means, and companies that sell good products is a conversation that everyone wants to have, right? All advisors want to be pointing their clients to good companies. And this is what sustainability can offer in terms of providing more information about what that company does. And so to come back to your question, Neil, around where do you find information? Well, there's plenty of sources, including the companies themselves, that are providing analysis on their own sustainability reporting, climate change reporting. So there's definitely availability of that data. I myself work for S&P Global, and we spend a lot of time analysing companies. We spend a lot of time analysing companies across all the perspectives of companies, financials, asset level data, the fundamentals, but also their sustainability profile. Even within the sustainability profile, there's a lot of different layers of analysis. We saw from the approaches that Leah put up, there's ESG integration, there's impact, there's screening. All of those different approaches to sustainability require different analysis. So we have teams and teams of people who are looking at this. There's over 800 people at S&P Global who do focus on ESG and sustainability analysis only.
Look, I think historically, if we think back to how, I guess, ESG or responsible investments were incorporated into portfolios, typically what we saw was, from an Australian perspective, was an Australian equity portfolio substituted in amongst a range of other managers, and that kind of suited most clients quite well. I'm doing good in this part of my portfolio, that's what I'm trying to do, with paying little regard to, I guess, what else was in your portfolio, whether it be your other equity managers, what they were doing, what they were purchasing, or whether it be on the fixed income side, who are you lending money to. I think, the market has evolved quite a lot, particularly in the last 2 years, and now we're really seeing clients demand, a whole of portfolio solution. So they're wanting to know that, the impact they're having is being had across the entire portfolio. So what we are seeing is a move towards more holistic portfolio construction, where we're seeing ESG and sustainability incorporated across each of the major asset classes. There's still some gaps, and we can touch on that later. But for the most part now, there's enough product availability and enough quality of products, particularly in Australia now, that you can build a fully diversified portfolio while still getting either impact or exposure to more environmentally, socially and governance-aware kind of strategies.
I think it's worth highlighting that measuring equity for ESG it's been relatively straightforward and quite standardised now for a few years. So you can quite easily look at a portfolio's carbon footprint relative to its benchmark, for example. We've started to see a move more into the managed account space. So I think once you move away from equities, it does get harder to kind of report from a total portfolio perspective. It's definitely gotten better in terms of ESG data for say fixed income, but trying to say that a multi-asset portfolio has got a 50% lower carbon reduction, let's say, is harder than doing so for a simple equity portfolio. That's evolving, but I think that's increasingly what advisors are. They're looking for that kind of information. And
again, coming back to the question focused on social issues, looking the examples I gave were very focused internally on the operations of the company, but nowadays that goes further into human rights and impact on local communities. We're measuring these details and bringing those into how a company is assessed. And using those in benchmarks that are created by S&P Global, whether it's a carbon efficient index or whether it's an ESG scores index, which then allows for the portfolios that we're talking about here to measure against a benchmark the same way you would measure the performance against a benchmark.
First, and what should be in an ESG portfolio and what shouldn't, and it really does come down to individual client preferences. It's really hard to design a portfolio when you're talking about individuals' values and ethics. What's important to me may not be important to somebody else. So it is important to have a conversation with your clients and figure out, do they want to be invested in tobacco? Do they want to be invested in gambling and those kind of issues, and really understand where they're coming from?
Look, I'll maybe start with the G, the governance side of things. And I think if you're in an active product, most fundamental equity managers are quite big on governance. They're obviously meeting company management. You generally have quite high governance scores, if you like. So I think on the whole, active management, you get the governance side on the whole, particularly if you're investing in ESG-based fundamental strategies. The social side is definitely more challenging, particularly from, a listed equity space. Leah mentioned, things like social housing. There aren't many kind of social housing stocks that are listed on the ASX. That there are things like healthcare. I think ESG-minded investors will often be overweight sectors like healthcare because that's a social solution and doing good for the community. And then just in terms of, what would you say to advisors? I think, it's a tough space, but just trying to get to understand, what's important to individual clients. We all know that, individual client ESG beliefs are quite personal. So, I don't think necessarily just blanket exclusions are the way to go. I've definitely become a firm believer in the increased use of engagement as well as a way to affect change. So I think that exclusions over engagement is a good kind of topic to have with your clients.